Hi everyone, this is Alvin from Dr. Wealth, and if you are into dividend investing, this is the video for you. I'm going to share with you a very effective yet simple strategy how you can use it to invest in Singapore blue chip dividend stocks. Okay, so without further ado, let me just introduce to you this strategy and the usual disclaimer, pause and read it if you need to. So this strategy is based on one of the more famous strategies that originated in the US known as Dogs of the Dow. Some of you might have heard of it if you are an old timer in the stock market, but for some of you who are newer to the markets, this is probably something new. All right. As we know, the Dow Jones Industrial Index is a very famous index in the world, right? It comprises 30 components and the top businesses in the United States, right? It is unlike the S&P 500, which has a lot more stocks. This Dow Jones Industrial Index that only have 30 stocks. Okay, so the dogs of the Dow is a very simple strategy. It just say that you should hold 10 of the 30 constituents. Okay, 10 of the 30 constituents, which is 1/3 of the entire index, right? So in this case, people might find that, oh, 10 stocks sounds very concentrated. Should I just buy the entire index? There is merits in picking the stocks from this index itself, right? Because it can help you improve the dividend yields, and it can also give you extra capital gain because what these stocks of the Dow propose is that you buy the top 10 constituent stocks with the highest dividend yield. Okay, with the highest dividend yield. So why would they want to suggest that? Okay, because first of all, these 30 components are very familiar blue chip stocks that already a very good screen from 5,000 stocks in the US. They pick out 30 stocks. These are probably the cream of the crop already. Very familiar names, and you can safely just buy the highest dividend yielding stocks because sometimes people fear that if you only buy the highest dividend yielding stocks, you are buying cheap stocks for a reason. They're cheap for a reason, and maybe they have some problems, blah blah blah. But because you're just using these 30 stocks, using very strict criteria to fulfill these Dow Jones Industrial Index rules, they are already pre-screened. So you don't need to do much fundamental analysis, in my opinion. Anyway, if they are really declining kind of business, they will be dropped out of this 30 stock index eventually. So by just staying with these 30 stocks in the constituent and pick the 10 cheapest one according to their dividend use, you will be able to buy the good stocks that are trading cheapest. All right, so that is why these dogs of the Dow is phrased this way. Okay, and these bigger cap stocks are generally safer, right? As I mentioned, out of 5,000, I'll choose 30 stocks. Okay, this to pass this criteria is not easy, right? You must be really very big business, very solid business. Otherwise, it's very easy to get kicked out of the index itself, and which means sometimes the share price will fluctuate, and if the share price correct, it can become an opportunity to buy this blue chip at a cheap price. Because I do know that some people, they like blue chip stocks, but they just don't know whether the stock is trading at a price that they should buy, right? So with this simple strategy, you don't need to think too much, right? Just rank all the constituents and you just pick the 10 out of the 30 stocks as your portfolio selection, right? With the highest dividend yield. It will take care of your value buys, right? Because highest dividend yield usually mean the share price is not expensive. So maybe I should explain to you why I say so, right? Because the dividend yield formula is as such. Okay, dividend yield is dividend per share divided by share price, right? So in order for your dividend yield to be high, okay, either your dividend per share is high or your share price is low, right? So that's why I mean, when you're looking at the 10 cheapest stocks by dividend yield in the Dow Jones Index, you are actually buying this kind of stocks by just using this dividend yield alone is good enough, right? They will tell you, okay, just by looking at the yield, this is the 10 cheapest stocks that you should be buying right now, right? So you don't need to think too much. Oh, I need to look at the PB, I need to look at TP ratio, I need to do some discounted cash flow. Those are probably too complicated for the layman or retail investor who doesn't want to spend a lot of time but still want to do their own DIY investing. This dogs of the Dow strategy becomes very relevant, and you just need this one metric, right? You first use the quality filter, which is the Dow Jones Industrial Index, the 30 stocks. Then within 30 stocks, you want to buy the cheapest, and you're using this highest dividend yield to fish them out. Okay, so that's what we are trying to do here. But as I said, we are not going to just adopt this, right? As the title suggests for this video, we're going to do it in Singapore stocks. Later, I'll share with you how to adapt it to Singapore stocks. Okay, and let's look at some historical performance of these stocks of the Dow. And he has done well, right? For a period of 20 years, okay, which is a long time. Stocks of the Dow has returned about 9.5% per year. That is higher than the Dow Jones Index, and it's also higher than the S&P 500 Index, which is a lot more diversified in that case, right? So with a simple strategy, you can just up the return, right? As good as a 1% higher than original index. I do think that it is worthwhile. The amount of effort is not, 10 times more, right? So you're able to edge out the extra return and you get higher dividend yield at the end of the day. So for some people who likes the cash flow, you are essentially getting more cash payout from the stocks that are investing in. But I would not suggest if you're a dividend investor to invest in stocks of the Dow strategy. The reason is because in the US, there's dividend taxation. So you're going to lose out 30% of your dividends to tax. And that is not practical, right? And that is why I suggest that we do it in Singapore. And that is the docs of STI. Okay, so it is not original, as you can see. I'm just adapting what works for docs of the Dow to docs of the STI, right? And it's very relevant because STI also have 30 components, right? Just like the Dow. And the advantage is that it has no dividend taxation in Singapore. Okay, so you can really save that 30% tax, which is substantial, right? And that means adding more cash flow to your retirement, adding more cash flow, you are living on dividends alone, right? So I do think that Singapore stocks are more worthwhile for dividends. And something peculiar is that for STI, it has quite a number of REIT exposure, right? So this is something that we don't see in that stocks of the Dow. It can be an advantage because, as we know, REITs distribute most of their rental income as dividends to shareholder. That means that your general yield will also go up when you do a dots of the STI. So I do see a lot of advantages, and that's why I want to share with you guys, all right, this strategy that is very simple. I will demonstrate to you how do you find that 10 stocks to buy in the dots of the STI. Okay, I did a back test using the pieinvesting.com. You can go and check it out if you like to do back testing on any strategy. So this strategy has returned 150% in terms of total return as compared to 13% of the STI ETF, right? So this is a ticker for STI ETF, right? As you can see over here, this is the strategy and this is the original STI, right? So it essentially, using this very simple strategy, it did 10 times better. Annualized return is about 6.8%, while STI was pretty flat at 0.9%. Oh, forgot to tell you the period of comparison. So we are looking at 2008 to 2021, so it's about 13 years, which is also a long enough horizon for us to, enough sample size for us to compare the performance, right? So you can see that people have been complaining STI is not giving me returns, it's been flat for the last 10 years, but you can see just by using and applying these dots of the STI strategy, you will be able to do 10 times better than original index. That is why I do think that dividend strategy in Singapore stocks are very, very superior. Okay, so how do you do this STI ranking or get the dots of the STI? These are the two key sites that you should be using, right? The first is that we need to determine the 30 stocks. So what are the constituents based on the latest ranking, right? Every quarter, there may be changes, there may not be changes, but it is important to always get the latest list of constituents so that you are not using, or you're not buying into stocks that have been kicked out of the index. That is very important, right? Because we use this index component as a sign of high quality stocks, okay? Familiar blue chip stocks that are doing well. And the second thing is that we need to find out the individual dividend yield, right? So SGX website provides both of this information, and I will share with you how to do it. And I'll be using a spreadsheet, right? And we probably know how to use a spreadsheet by now, and it's always very useful when it comes to investing, especially if we are doing quantitative investing, like what we are doing right now. We can easily extract the data, and we can do a simple ranking, and we can just identify the top 10 stocks. So I'll be doing it right now in front of you, okay, in this video, so that you can know how to do it yourself, right? So this is the STI component page. So these are the 30 stocks, okay? So what I'm going to do is that I'm going to just copy and paste the whole list here, right? Hope it pays properly. Okay, it doesn't pay properly. So which means I need to just type it out, right? No worries, because there's just 30 stocks, so it's going to be pretty fast, right? Capital Land, Integrated Commercial Trust, City Development, Comfort Delgro, Dairy Farm, DBS, Fraser's Logistics and Commercial Trust, Genting Singapore. Right. Okay, we are almost halfway there. Hong Kong Land, Jardine C&C, Jardine Medicine, Keppel DC, Maple Tree Com, Maple Tree Log, and Maple Tree Industrial. Right, we are more than halfway there. OCBC, SATS, Samcorp Industrial, which is also good that we type it through, right? So that you can also get a sense, the latest list of STI component stock, ST Engineering, Thai Bev, UOB, UOL, and Venture, Wilmar, and Yang Zijiang. Okay, so we got our 30 stocks, right? So the next thing that we need to do is to rank the dividend. So this is the stock and this is the dividend yield. Okay, so how do I get a dividend yield? We can just simply click on the stock name over here. Right, click on the stock name over here and we will be able to go to their valuation and we can see the dividend yield, right? So in this case, this is about 4.4%. And we can go to the second one, which is Capital Integrated Commercial. Yeah, have a 4.46%, right? Pretty good, decent use. City Development. Oh, sorry, this is Integrated Com. Okay, because I do think that just now I re-ranked the stocks. It got a bit haywire, right? But not to worry. Just want to make sure that we got the correct one. So this is pretty low, 1%. Okay, and Comfort Delgro, 2.54%. And let's look at Dairy Farm. So as you do it, as you put in the numbers, you get a feel, right? What stocks are paying what kind of dividends. This is quite decent, 4.85%. And DBS, 3.2%. Fraser's, where is Fraser's? Okay, they were dropped to the bottom. I don't know what happened to the ranking. 4.9%. So you can see generally the REITs are giving higher returns, and we missed out this the last round. So let's just key it in now. Okay, there's no dividend yield for this because I think this was recently have a merger and acquisition, right? M&A activity. So they don't have a full year dividends yet. So it's okay, we just leave it blank, right? Next year we'll have it when they start giving dividends again. This is Genting. Genting has 1.3%. I'll just put 0 for here. Hong Kong Land. It's about 4%. Let's go for Jardine C&C. Should be quite good, right? 3.3%. The Jardine related companies are around there. 3.294. Jardine Medicine. Excuse me. 3%. And Keppel, 3.6%. So quite a number of them are in the 3-4% range. Keppel DC, Capital DC, right? 3.6%. Maple Tree Commercial, 4%. Maple Lock, 'So when you do your numbers, just make sure that you are looking at the right stock, because sometimes the list may be adjusted. So just make sure that you copy to the right stock. Okay, otherwise you might buy the wrong one. OCBC is 3.6%. SETS 1.5%. That's pretty low. Samcorp Industries 2.985. SIA 1.139. See, mistake. Okay, so SIA, but SGX came first, so we missed out SGX. 3.4%, and this is Singtel. Next, 2.28%. ST Engineering, 3.9%. Thai Beverage, 2.7%. UOB, almost there, right? Then we can do a ranking. 3.7. UOL, 2.1%. Venture, 3.9%. Wilmar, and last one is Yangzijiang. 3.3 for Wilmar, and Yangzijiang is at 3.4. So you can see all of them give dividends, right? Except one, this capital investment firm, because this is a new company, right? Just newly formed after a merger and acquisition. So next year, I believe we will see dividends given by this stock also, right? So let me just do a ranking. Okay, let's do a ranking over here from the highest to the lowest. All right, so we look at the first 10 stocks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, these are the 10 stocks that form your dogs of the STI right now. Frasers L&C, Dairy Farm, Capital Land Integrated Commercial Trust, Ascenders REIT, Maple Tree Industrial, Hong Kong Land, Maple Tree Commercial, Venture, ST Engineering, and Maple Tree Lock. Okay, this is normal, right? You tend to see more REITs because they have an advantage due to the fact that they tend to give more dividends, right, than normal stocks. And it is that way, the nature of STI, okay, and the nature of REITs itself. And we can see that the minimum yield is around 3.9%, right? So that is definitely higher than the average yield if you buy the entire index. So naturally, your dividends will go up, right? Your dividend that you receive per year will go up by using this strategy. And at the same time, this also tells you that these 10 stocks are relatively cheaper than the rest of the blue chip in the STI index. Right, so you can see it's a very simple strategy, but it's very effective. Okay, and I show you just now that the performance is pretty good, right? You do 10 times better than STI for the same period that we compare in the last 13 years. Okay, so what do you do, right? Let's say you buy the first 10 stocks, and how do you rebalance it, or how do you monitor your portfolio thereafter? Okay, so another thing I need to tell you is that when you buy your stocks, right, these 10 stocks, it is you use an equal weight ranking, right? So that means 10 stock, 10% each. Each stock takes up 10% of the weightage of your portfolio, so it's equally weighted throughout. You don't need to do like some esoteric kind of weighting, so you keep it easy, right? So 10 stocks, 10% each weightage. And when you come to monitoring, you don't need to look at the stocks every day. You don't need to look at stocks every week or even every month, right? You don't need to look at the company announcements. You don't need to look at news. So that is what is the beauty of this strategy, because it is very hands-free and you don't need to spend a lot of time analyzing them. And that means that if you're someone who has no interest or very little interest in understanding the stocks or doing readings on the annual report, this will be a very suitable strategy. And you just need to do this once a year, right? So if you buy this year, next year, 1 year later, you will do a rebalancing. Okay, so you take out the new list again, right? You check the list whether there's any stocks that get kicked out or new stocks that get added. So if a stock that's kicked out, you have to sell that stock and replace with a new one, right? Within the top 10 stocks again. So you just repeat what I just show you every year, and it doesn't take you a lot of time, right? And what I showed you just now was like just 5 minutes, I get the ranking out. Okay, so I do believe that it is simple enough for you to do it. It's just whether you have the discipline to do it. It's not difficult at all. And if let's say the stock is still within the 30 companies, but it's outside of the 10 stocks, right? The top 10 stocks by Dividend You, you should also sell it and replace with the new one that entered the ranking. And same thing, sometimes the stock will appreciate. Let's say, assuming your dairy farm, after you buy next year, it became a 15% allocation in your portfolio. That means the share price have gone up, right? So what do is that you rebalance, you sell 5% so that it goes back to 10%, right? Because we want to equally weight the stock. So some stocks will go up, some stocks will go down in the entire year. What we do is that we do rebalancing. Any stocks that fall below the 10%, right, we buy. Any stocks that fall above the 10%, we sell. So everything goes back to the 10% every time when you rebalance. Okay, and also make sure that any stocks that get out of the ranking, you have to sell them and replace with totally new ones that have entered the ranking. The rest of stocks that are still existing inside, you do rebalancing. Okay, this will help you do your capital gain, capture your capital gain as the share price move up and down. The mantra is the same, buy low, sell high. All right. So it is important to write expectation. The reason is because no strategy can outperform every year, right? Even though I show you like over 10 years, the strategy outperformed the STI by a mile, 6 times better. But it doesn't mean that every year these dots of the STI will beat the STI. There can be some years that, you know, the original STI do better than these dots of the STI. But you have to have the confidence and the conviction that, you know, if you do this strategy long enough, there will be more years that this strategy will outperform the STI, right? But I do know that, you know, during periods of underperformance, that's where a lot of investors would like to jump ship, right? They like to look at another strategy. They like to they always look at the grass is greener on the other side, right? Because, oh, you see, I'm underperforming, another strategy is better, I should swap. This is not a wise decision, because any strategy that is outperforming right now, right, is actually overvalued, right? Because they have gained a lot. And as I said, no strategy outperform every year. So the chances of it underperforming in the future, right, it can be higher, right? And you don't want to be always chasing after performance, right? That means that you are always moving into a strategy that's working. That means you're always buying high, right? And then when a strategy underperform, you're abandoning it, means you're always selling low. Okay, so this kind of buy high, sell low phenomenon also happen if somebody is pursuing investment via strategies, right? People tend to abandon strategy that's not doing well and hop onto ones that are doing better, right? So it's a typical buy high, sell low kind of activity. So you have to make sure that you have the right expectation, and you do need that kind of discipline and patience to stick with the strategy long enough to see the performance, right? So in summary, I share with you dots of the Dow strategy. That's where the dots of the STI strategy was adapted from. It has been around for many decades in the US, and it has also performed very well, right? Beat the original Dow Jones Industrial Index, and the same that we saw in STI as well, right? But I do see that because without a dividend taxation, buying high dividend stocks in the dots of the STI might do even better than the dots of the Dow. And this is a good strategy in the sense that you're just buying familiar blue chips, right? Because I do know that small caps, yes, they can give higher returns, but not everyone is familiar with buying small cap stocks. because they are usually unfamiliar names in businesses. They are not so sexy, but familiar blue chips are more palatable for most people. Okay, and you can also run this for, let's say, your SRS funds or CPF funds, because the dividend yield easily can beat that 2.5% interest that is generated by your CPF ordinary account, right? Of course, your CPF money is capital guaranteed; it doesn't fluctuate, so you don't experience the volatility. When you do this lots of the STI, you will experience price volatility because there will be some years that the market will crash and your principal will go down in value, right? So if you really want to use this strategy for your CPF funds, just be aware of that risk, and you must be available, able to accept this price drop, right? If you cannot accept, then I think you shouldn't invest your CPF funds. You can stay with cash or what, right? Where you feel that, you know, make your money work harder. Anyway, your CPF you get a 2.5%, right? So I leave it to you. Okay, I just want to mention the risk that's there. And the last thing is that you don't need to monitor the stock market so frequently. You don't need to do deep analysis, and this is a very simple strategy that can help you beat the index already and increase your dividend payout every single year. So you just need to rebalance a year, right? And it just take like probably, you know, including your buy sell adjustment using your broker, I give you 1 hour a day, 1 hour a year, right? 1 hour a year, and you can do better than the index. I do think that this is almost close to a free lunch, right? That you can really exploit as much as possible. So I hope you like this dots of the STI strategy. And if you like what I've shared, like this video please, and also subscribe to the channel. And I'll share with you more things as I uncover more interesting strategies or more interesting analysis in this channel. I'll see you the next time. Cheers.